All right, welcome to The Explainer. Today, we're diving right in, stepping into the shoes of an experienced investment analyst to put one of the most dominant companies on the planet through Wall Street's absolute most rigorous valuation models. We're taking Walmart, a retail titan with an unassailable physical footprint, and we're going to stress test it against the legendary investment frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, as well as modern discounted cash flow and comparative models. So, is this stock a fortress of value, or is it just priced for perfection? Let's run the numbers. Okay, let's dive into this. Here is our 6-step gauntlet for today. 1. Snapshot and Buffett lens. 2. The Peter Lynch lens. 3. The Benjamin Graham lens. 4. Discounted cash flow valuation. 5. Other valuation models. And 6. Synthesis and final verdict. Let's get to it.
Section 1. Snapshot and Buffett lens.
To ground us, let's just look at the cold, hard reality of Walmart's market position. At the close of fiscal year 2026, the stock was trading at $272.28 per share. We're talking about a company that raked in over $713 billion in total revenue. It's an absolute behemoth. But, as you know, a great company doesn't automatically equal a great stock. When we throw on the Warren Buffett lens, we're hunting for a few very specific things. We want that massive economic moat, highly consistent earnings, a high return on equity, and manageable debt. And crucially, we need intrinsic value with a wide margin of safety. Buffett wants to know that even if things go completely sideways, his capital is protected. Basically, he wants to buy a dollar bill for 50 cents. Now, qualitatively, Walmart crushes Buffett's tests. They pulled in nearly $21.9 billion in net income on roughly $99.6 billion in equity. That is a massive return on equity of nearly 22%. The return on investment? A rock-solid 15.1%. Plus, the debt is totally manageable given their incredible cash flows. Buffett would absolutely love this underlying business. But at $272 a share, that required margin of safety is completely missing. Section 2. The Peter Lynch lens. So the very first thing you have to do with Lynch's framework is categorize the company. Based on its sheer size, Walmart is the ultimate stalwart. This isn't some high-flying, nimble tech startup, right? It's a mature giant with over 10,000 global locations. Zacks consensus estimates have sales growth at 4.5% and EPS growth at 4.8%. It is the literal definition of a slow, steady stalwart. And to value a stalwart, Lynch popularized the PEG ratio, which takes the price-to-earnings multiple and divides it by the earnings growth rate. It essentially tells you what you're paying for every unit of growth. Now, Lynch loved finding companies with a PEG of 1 or lower, but when you take Walmart's forward PE of 39 and divide it by that 4.8% projected growth, you get a PEG ratio of 8.13. Absolutely wild. So here's the Lynch verdict. You've got a pristine balance sheet and incredible skill, for sure. But a stalwart trading at a PEG north of 8, that's fundamentally incompatible with his whole philosophy. You're paying a massive premium for single-digit growth. Under this lens, that sky-high valuation would likely trigger a clear hold or even a sell. Section 3. The Benjamin Graham lens. Graham was notorious for his strict defensive investor checklist. Now, Walmart easily passes on adequate size, earning stability, and a reliable dividend. But then, we hit the valuation limits. Graham wanted a moderate PE ratio, usually under 15. Actually, scratch that. Walmart is sitting all the way up at 39. Graham would probably roll over in his grave at that multiple. He also wanted a price-to-book ratio under 1.5. Walmart's is pushing 22. It just completely fails his strict value rules. Now, what's really interesting about this slide is the stark reality of the math. If we calculate Graham's intrinsic asset value using his classic formula, factoring in $2.73 of EPS and a $12.48 book value, we get a fair value of exactly $27.68. Remember, the stock is trading at $272. By Graham's ruthless asset-based math, there is absolutely zero margin of safety here. Section 4. Discounted cash flow valuation. Okay, let's put the guru heuristics aside for a pure DCF model. This strips away market sentiment and just asks one simple question. How much cash will this business generate over its lifetime, discounted back to today's dollars? The steps are straightforward. First, forecast the free cash flows. Second, calculate a terminal value for the company's mature state. And third, discount it all back using the weighted average cost of capital, or WACC, which is just the return investors demand for taking on the risk. To fill in the forward-looking gaps, we're making some explicit, rational assumptions based on the data we have. We'll use Zach's projected revenue growth of 4.5%. For the discount rate, we're assuming a mature retail industry average WACC of 7.5%. And for terminal growth, basically how fast Walmart will grow forever, we're using 2.5%, which roughly tracks long-term inflation and GDP. Let's look at this sensitivity analysis. Even if we give Walmart every benefit of the doubt, like, say, dropping the cost of capital down to 6.5% or pushing the terminal growth to a super optimistic 3.5%, the math just doesn't work out. Growing a base of roughly $16 billion in free cash flow at just 4.5% a year doesn't bridge the gap. Even an optimistic DCF falls radically short of that $272 market price. The market is pricing in a level of cash flow growth that frankly defies reality for a mature stalwart.
Section 5. Other valuation models.
When we look at relative valuation through comparable multiples, it is pretty wild. Walmart's forward PE is 39.04. Its traditional retail rival, Target, trading at just under 14. Meanwhile, Costco, which operates a completely different high-margin membership model, is at 44. The market is valuing Walmart at a massive premium to Target, basically pricing it as if it has Costco's membership moat. If it traded at a traditional Target multiple, Walmart would be sitting closer to $37 a share.
Section 6. Synthesis and final verdict.
When you line all this data up side by side, the contrast is just undeniable. Graham's strict asset value spits out $27. The DCF output, even when we're being generous, is radically lower than current levels. A Target-like multiple puts it in the 30s. Only a Costco-like multiple even begins to justify a premium. And even that falls well short of $272. The current market price is just operating on a totally different plane of expectations.
So what's the bottom line here? The strengths are legendary. You've got dominant global scale, incredibly consistent earnings, and a phenomenal 15.1% ROI. The business itself is a well-oiled machine, but the risks? They're entirely valuation-based. Buying a mature retailer at 39 times forward earnings with a PEG ratio over 8, you're leaving yourself with literally zero margin of safety.
We literally cannot ignore Walmart's physical reality. Almost 11,000 locations worldwide. It's an unassailable moat that just prints cash. But as any seasoned analyst will tell you, a great company can be a terrible investment if the price is wrong. When we blend Buffett, Lynch, Graham, and modern DCF math, Walmart is a brilliant business trading at a remarkably demanding price. For a disciplined value investor, this is a hold at best. You're basically waiting for a market correction to give you a true margin of safety.
Which brings us to one final thought. The market is clearly willing to pay a huge premium for the safety and dominance that Walmart offers. But as an investor, you have to ask yourself, is a world-class moat really worth paying an infinite premium for? Or does true safety only come from the price you pay? Something to think about as you review your own portfolios. Thanks for joining me on this explainer, and I'll see you next time.